Welcome to the TAC Index AI Podcast Weekend Edition, where we blend TAC IP data, reports, and charts with the latest news in all things logistics, with a focus on air cargo. Our mission today is really to take a deep dive into the key air cargo updates from August 27th right through to August 30th. We're going to try and unpack how these trends, combined with the broader macro market shifts and some, frankly, pretty significant geopolitical events, might just shake up logistics and the global economy. Okay, let's unpack this. This past week, it's been kind of a fascinating study in contrasts, hasn't it? We've seen some subtle shifts, sometimes counterintuitive ones, in air freight rates, and this is happening even as demand seems, stubbornly high in very specific high-value sectors. Then, swirling around all this, you've got major developments in global trade policy alongside these volatile energy markets. It all paints a picture that's far more complex than just glancing at a headline index might suggest. So, looking at the latest TAC index data, what's the immediate, maybe the most surprising takeaway for you, especially as we head into what's usually a quieter period?
What's truly fascinating here, I think, beyond just the surface numbers, is the underlying tension they reveal. The overall Baltic Air Freight Index, the BAI-N0, it did ease slightly lower again, dipped about minus 1.7% week on week, and it's down about 8.2% over the last 12 months. Now, on its face, that suggests, a cooling market. But the paradox, as you hinted at, is that we're simultaneously seeing really robust, continuing high demand in specific crucial sectors. Think garments, pharma, electronics, semiconductors. We're even hearing reports of capacity constraints, actual delays in those very markets.
So you have this headline number suggesting things are cooling down, but then the anecdotal evidence, the word on the street, is hotspots where demand's soaring and capacity's tight. How do we reconcile that? Is this just a temporary blip, or does it signal something more fundamental about how air cargo markets behave during this so-called low season?
That's really the crux of it. The primary reason for this, seemingly contradictory movement is indeed the continuation of the traditionally quieter summer low season. Even with those high demand pockets, the overall market volume during this period just isn't enough to consistently push general rates upwards across the board. The key insight for businesses, I think, isn't just that overall rates are down. It's that if you're shipping, say, semiconductors, you might still face real challenges. Savvy operators, they aren't just looking at the BIR0. They're likely already positioning for the Q4 surge, maybe trying to lock in capacity on these high-demand lanes now rather than waiting for the market to publicly signal a turn.
That's a critical distinction. Yeah, it's not like a uniform calm across the whole ocean. It's more like quiet pools, but with these rapid currents flowing underneath. And this becomes even clearer when we drill down into the regional data, right? The nuances across the different trade lanes, they tell a much richer story. What did you notice first looking at these specific movements? Anything that might surprise our listeners?
Absolutely. The regional data is really where the true complexity of air cargo operations shines through. Out of Asia, for instance, we saw rates from China to Europe holding pretty flat, while dipping just slightly lower to the U.S. From North Asia, there was this new lane to Mexico that also saw rates ease a bit. Hong Kong's BAI-30, that's a key index, it dropped minus 2.3% week on week, down 9.8% year on year. Though spot rates there were largely unchanged, interestingly. Shanghai's BAI-80 also saw a modest dip, minus 0.4% week on week.
Okay, so a general softening out of China's major hubs, which kind of makes sense in a low season, but you mentioned new lanes. What's the significance there, seeing new lanes pop up, like the one from North Asia to Mexico? Is that just noise, or does it signal something more strategic, maybe rerouting by carriers or shippers?
That's a great question. These new lanes, they're actually quite significant sometimes. They often signal a strategic rerouting by carriers, or maybe a response to evolving demand patterns as supply chains diversify or pivot. For instance, that new lane from North Asia to Mexico. It could indicate a growing nearshoring trend for manufacturing. Or maybe it's a response to congestion elsewhere. That's a key long-term implication for logistics planning. It's not just a data point. It's like a conceptual indicator of how the market's adapting.
Got it. Adaption in action.
And beyond China, other parts of Asia showed more varied patterns. Vietnam, for example, rates were lower to Europe, but surprisingly higher to the U.S. We saw something similar from Bangkok, rates higher to the U.S. on another new lane. Seoul presented almost a mirror image. Higher rates to Europe, but lower to the U.S., again on a specific new lane. And India, which is always a market reacting to diverse global forces, saw rates higher week on week to the U.S. and Germany and Europe more broadly. Though it's important to note they're still significantly lower year on year. It's a real patchwork of diverging trends out there.
Wow, that is quite a lot of movement for a supposedly quiet season. It really sounds like if you're managing a global supply chain, you just can't rely on broad strokes. You need that granular intelligence specific to your routes. What about Europe? Did we see similar mixed signals coming out of there, or was it more consistently trending one way?
Europe, too, was definitely a story of divergent paths. Out of Europe, rates were actually higher week on week on certain lanes. Think India, Australia, Japan. But we saw them soften on others, including important ones to the U.S., China, and South Africa. And there was a particularly sharp movement, more than 10% down week on lanes heading to Brazil and Mexico.
Over 10%. Wow.
Yeah, Frankfurt's BAI 20 index dropped minus 3.1% week on week. And this was despite a curious surge in rates to Shanghai, interestingly. That left it lower by 2.3% year on year overall. London Heathrow's BAI 40. It also gave back some pretty large recent gains. A steep fall on transatlantic rates pulled it down minus 6.1% week on week, though remarkably, it still remains ahead by about 4.5% year on year.
That steep fall for London Heathrow, especially after recent gains, that's really striking. What's the underlying factor there? What's driving such a big correction in transatlantic rates? Does it tell us something about that specific market beyond just the numbers?
That's a great observation. I mean, while seasonal fluctuations always play a part, a sharp correction like Heathrow's on the transatlantic, it could indicate maybe an overcorrection after a period of, let's say, speculative pricing. Or perhaps it was a sudden injection of capacity into that specific corridor, belly capacity maybe. It might also reflect softening demand for certain goods, or perhaps a shift by some shippers to sea freight for cargo that's less time sensitive. It just suggests a market that's highly reactive, very sensitive to even minor shifts in supplier demand signals right now.
Highly reactive. Okay. And from the U.S., what were those trends looking like? How do they fit into this complex global tapestry?
From the U.S., rates were generally higher overall, heading to Europe and South America. However, we did see declines on some specific new lanes, like to the UK and Brazil, and also to Seoul and China. Chicago's BAI 50 index, it did gain plus 1.8% week on week, but it's still significantly lower, minus 15.4% year on year. That reflects that broader year-on-year trend we've seen. And lastly, rates out of Mexico heading to Europe were a little lower week on week, but they remain comfortably ahead year on year, perhaps benefiting, as you said, from those near-shoring trends we touched on earlier.
So it seems the clear takeaway, if you're a supply chain manager listening, is that even in this traditionally quiet air freight season, you absolutely cannot assume a flat market. Not at all. You need to drill down into those specific trade lanes, understand these emerging new lanes, track those divergent regional trends. It truly demands, well, serious agility and real-time data to navigate effectively.
Precisely. The headline index, it can be misleading sometimes. The actual operational reality is one of these micro markets, each with its own dynamics, influenced by specific product demand, carrier strategies, maybe even geopolitical ripples. Ignoring these nuances means potentially missing opportunities, or maybe worse, facing unexpected delays and cost escalations down the line.
Right. Okay, moving on from the market pulse itself, let's talk about those broader global economic currents impacting logistics. It seems President Trump's tariff policies continued to create some pretty significant ripple effects and some new uncertainties this past week, particularly between, what was it, August 27th and 30th. It started with an immediate impactful hit on India, didn't it?
Yes, it did. On August 27th, the Trump administration doubled tariffs on Indian goods, doubled them to a steep 50%. And this was explicitly framed as a response to India's continued purchases of Russian oil. This is a considerable blow, potentially, to India's biggest exporters, apparel manufacturers, furniture makers, shrimp farms, diamond traders. The list goes on. India's finance ministry has already acknowledged potential ripple effects on their economy. And if we connect this to the bigger picture, this action really highlights how geopolitical alignments are increasingly translating directly into trade policy, creating immediate hurdles for certain supply chains.
That's a really powerful demonstration of tariffs being used as a tool of foreign policy, not just purely economic strategy. And this isn't happening in a vacuum, right? It's part of a much broader existing tariff landscape that international businesses are already trying to grapple with.
That's exactly right. As of August 27th, just to recap, we have China facing 30% tariffs, with that negotiation deadline extended out to November 9th. Mexico has 25%, with a threat to raise it to 30% also extended for negotiation. Canada's at 35%. The EU, Japan, South Korea, they're at 15% after striking deals. Taiwan faces 20%, with that significant 100% on semiconductors threatened, though there are potential exemptions being discussed. Even Vietnam has 20% plus a 40% tariff, specifically for goods transshipped through the country. It's a really complex, constantly shifting web that companies have to monitor.
A shifting web, indeed. And just when businesses might feel they're starting to get a handle on it, a major legal challenge emerges, something that could potentially reshape the entire playing field. On August 30th, a divided U.S. appeals court dropped, well, kind of a bombshell, ruling that most of Donald Trump's tariffs are actually illegal. That sounds monumental.
It absolutely is. The 7-4 decision by the U.S. Court of Appeals for the Federal Circuit found that the law Trump cited, the International Emergency Economic Powers Act, or IEEPA, well, it doesn't explicitly grant the president the power to impose tariffs like this. Historically, IEEPA has been used for things like freezing assets or blocking transactions during national emergencies, not typically for broad tariff imposition. That's why this court ruling is so significant. It fundamentally questions the legal framework, the very basis underpinning these trade measures.
Okay, so what was the immediate market reaction to such a huge ruling? And what are the maybe longer-term implications for the stability of global trade? Did markets panic? Interestingly, there was little immediate impact in after-hours trading. That's likely because the court allowed the tariffs to stay in place until October 14th. That gives the Trump administration time to appeal to the U.S. Supreme Court, which they're expected to do. However, experts did note mounting concern over the independence of the Fed tends to imply rising yields and just a general market need for less uncertainty on trade. That was the underlying sentiment. This ruling, if it's ultimately upheld, raises a really important question about the long-term stability of trade relationships and the legal framework underpinning them. It could potentially force a major reevaluation of how trade policy is made and enforced in the U.S. It's just a huge question mark hanging over international supply chains right now.
It really is like navigating a minefield where the map keeps changing, sometimes fundamentally changing overnight. Okay, beyond trade policy, let's talk about something absolutely fundamental to air cargo, energy markets, specifically jet fuel implications. On August 27th, we saw some notable movement in oil prices. What was driving that volatility? Indeed. Brent crude futures, they were up 1.2% to $68.05 a barrel, and West Texas Intermediate, WTI, gained 1.4% to $64.15. Now, this came after both contracts had actually fallen over 2% previously, so it's a bit of a bounce back. Several factors seem to be at play. U.S. crude inventories dropped by 2.4 million barrels, according to the EIA data, and both gasoline and distillate stocks also fell. That was partly attributed to strong demand expectations for the upcoming Labor Day weekend. Domestic demand often acts as a baseline driver,
Right, the holiday weekend effect. So domestic demand played a role, sure, but were there other factors, maybe more global or geopolitical things pushing and pulling prices?
Oh, absolutely. Those new U.S. tariffs on India, the ones
Yeah.
specifically linked to their Russian oil purchases, they were also in focus. That created uncertainty that deterred some traders, showing again how trade policy directly impacts energy markets. Geopolitical tensions contributed too, of course. You had the ongoing Russia-Ukraine attacks on energy infrastructure and also Russia's revised plan for higher August crude exports.
Okay.
All of that adds to the general volatility.
So what does this all mean then? We're seeing fuel prices react to this cocktail of domestic demand, geopolitical shifts, the ripple effects of trade policy. For air cargo, I imagine the direct connection to jet fuel costs is just paramount.
It's absolutely critical. These movements in crude oil prices, they directly impact the cost of jet fuel. And jet fuel is often the single largest operational expense for air cargo carriers. Rising fuel costs could put upward pressure on air freight rates. Or if rates can't rise because of market conditions, it really squeezes airline margins significantly. That could force them to potentially cut capacity or rethink routes. It's a constant balancing act for them. And just to add another layer of complexity here, the New York Federal Reserve Bank President John Williams, he indicated that interest rates would likely fall at some point. But policymakers would wait for more data before deciding on a cut at the September meeting. Lower rates could boost economic growth and therefore demand for oil, further influencing prices down the road.
So beyond the immediate cost per gallon, how do these global energy signals, these monetary policy signals, how do they influence strategic decisions for businesses relying on air cargo? It's not just about today's price, is it? It's about anticipating future trends to secure capacity, manage risk.
Precisely. These signals inform longer-term planning for both shippers and carriers. Companies might implement hedging strategies, for example, to try and lock in fuel prices, or egg carriers might accelerate fleet modernization programs to improve fuel efficiency. Furthermore, the outlook on interest rates and economic growth influences those bigger decisions. Things like expanding capacity, investing in new aircraft, or even choosing sea freight over air for certain routes if the economic winds shift significantly. It's all about risk management, really, and trying to stay ahead of the curve in a pretty volatile environment.
Yeah, staying ahead of the curve seems key. And speaking of broader economic signals, what other macro indicators were making headlines this week? Things that air cargo and logistics professionals should probably keep an eye on.
Well, the market overall hit some new highs, but it was largely driven by tech optimism. The S&P 500 reached another all-time closing high. I think it's 19th of the year already. That was primarily lifted by investors' expectations for blowout results from Nvidia, which is currently the world's most valuable company. The tech-heavy Nasdaq composite also edged higher. So this indicates a really strong tech-driven rally in the stock market, which, in turn, often fuels demand for air cargo to transport those high-value components and finished products quickly.
Okay, so a lot of excitement around tech, but we also saw, as you mentioned briefly, some potential political interference impacting the Federal Reserve. How does that factor into the broader economic landscape for logistics?
That's another critical point, yeah. President Trump's firing of Federal Reserve Governor Lisa Cook and his stated intent to quickly nominate a replacement definitely sparked concerns over the independence of the Fed. This kind of political interference, if it undermines market confidence in the Fed's autonomy, could imply potential long-term rising yields, according to some analysts. That adds another layer of uncertainty to the financial landscape. Higher borrowing costs for businesses can certainly impact investment in things like infrastructure or fleet expansion within the logistics sector. And amidst all this, we also had some interesting retail insights. Shares in Kohl's climbed roughly 20% after reporting improved profits and sales that fell less than expected. That suggests pockets of consumer resilience, which could translate into demand for certain consumer goods moved by air or sea.
Hmm. This raises a really important question, I think. In a market that's being driven by this tech optimism, but simultaneously facing shifting trade policies, navigating volatile energy costs, how does the underlying logistics infrastructure, particularly air cargo, adapt? How does it support these evolving demands while grappling with such pervasive uncertainty? It feels like the air cargo sector is constantly just reacting to these broader forces.
It absolutely is. Air cargo is essentially, the circulatory system for many of these high-value, time-sensitive goods that drive the modern tech economy. So while the stock market might be celebrating tech highs, the logistics sector is busy grappling with how to efficiently and cost-effectively move these components and finished products across the globe. And they're doing this all while navigating tariff changes that can redirect trade flows almost overnight, volatile fuel prices that directly impact their bottom line, and this broader economic and political uncertainty that can quickly shift demand or capacity. The ability to adapt quickly, to secure diverse capacity, and accurately forecast demand becomes absolutely paramount in this environment.
We've certainly taken a deep dive into a truly fascinating and complex week, haven't we? We started with this nuanced air freight market, still navigating its low season where global rates might be easing overall, but specific lanes are seeing really significant, often divergent shifts. Then we explored this rapidly evolving global trade landscape. New tariffs being imposed on countries like India, while other long-standing tariffs are facing serious legal challenges right here in the U.S. courts. And underpinning all of this, you have the fundamental impacts of energy prices, directly hitting jet fuel costs and operational margins, coupled with those broader economic indicators like tech-driven market highs and concerns over central bank independence.
Yeah, it's clear that all these elements are just profoundly interconnected. It creates a very dynamic, often unpredictable environment for anyone involved in logistics and global trade today. Businesses really need to think beyond the immediate numbers, I feel, and understand these deeper currents.
Absolutely. So as we wrap up, here's a final, maybe provocative thought for you, our listeners, to consider. Considering all these conflicting signals from a quietly volatile air freight market to a legally challenged tariff regime, and from soaring tech stocks to fluctuating oil prices, how will businesses balance that immediate need for agility in their supply chains with the pervasive long-term uncertainty in the global economic and political landscape, particularly as we move out of summer and start heading towards the typically busier holiday season? We definitely encourage you to keep thinking about these connections in your own fields and observations.